So, the stock market. You hear about it all the time, right? But what does it a game? See, at its heart, the stock market isn't about placing bets, it's about ownership. Seriously, when you buy a stock, you're literally buying a tiny piece of a real company. You become a part owner. You have a claim on everything they own and a slice of all the money they make in the future. Okay, so that brings up a good question. Why do we even have a stock market? What's the point? Well, it's pretty clever, actually. It serves two really important purposes all at once. So, on one side, you've got the companies. They need cash to, build new factories, invent cool stuff, and just plain grow. By selling little pieces of themselves, shares, they get that money from people like us. And for us, well, that's the other side of the coin. It gives us a chance to build real wealth by owning a piece of those successful growing businesses. All right, so let's get down to brass tacks. When people talk about trading, what is the thing they're actually trading? Let's break down the most basic piece of the puzzle. Okay, so that thing is a stock, or what you might hear called equity. And it's exactly what it sounds like, a share of ownership. The pizza analogy is perfect here. Think of a giant company as a huge pizza. When you buy one share of their stock, you're buying one slice. It might be a small slice, sure, but it's your slice of the whole pie. So how do you get your hands on a slice of that pizza? Well, it happens in two main phases. First up is the primary market. This is the big launch party, the IPO, the initial public offering. It's the one and only time the company itself sells brand new shares directly to the public to raise money. After that, the party moves to the secondary market. This is your everyday stock exchange like the NYSE or NASDAQ. From here on out, it's just investors like you and me buying and selling those shares from each other. Okay, so we've covered the why and the what. Now for the really practical part, the how. When you're actually ready to pull the trigger and buy or sell something, you've got a whole toolkit of order types to tell your broker exactly what you want to do. So the first thing you'll notice are two prices for every stock. There's the bid price and the ask price. Think of it like this. The bid is the highest price a buyer out there is willing to pay right now. The ask is the lowest price a seller is willing to accept. Simple, right? So if you're buying, you pay the ask. If you're selling, you get the bid. Now, the most basic orders you can place really come down to one simple choice. Do you want speed or do you want control over the price? If you want speed, you use a market order. It's like saying, get me in now, I don't care about the exact penny. But if you want control, you use a limit order. That's you saying, I'm only buying at this price or better. Let's walk through a quick example of both. Imagine there's this tech stock you've been watching and you decide, okay, I want in, and I want in right now. You'd use a market order. Boom. Within seconds, your order is filled at whatever the best price is at that exact moment. You've got your shares, just like that. The price might wiggle a few cents from what you saw on the screen, but you're in. Okay, but let's say you're not in such a rush. That same stock is trading at 105 bucks, but you've done your homework and you're thinking, nah, I'll only buy it if it hits 100. So you place a limit order at $100, and that's it. Your order just sits there, patiently waiting. If the stock price ever drops down to your price, your order gets filled. If it doesn't, nothing happens. See? You're in total control of the price you pay. All right, there are also orders that are like your own personal safety net. A stop order, sometimes called a stop loss, is pretty straightforward. You own a stock, and if it starts to fall, this order automatically triggers a sale to get you out and limit your losses. It becomes a market order, so it sells fast. Then there's the stop limit order, which is a bit fancier. It does the same thing, but instead of a market order, it becomes a limit order. This gives you protection with price control, so you don't sell for less than you're comfortable with. Okay, so you've got the tools, you understand the order types, but here's the kicker. Knowing all of that stuff is maybe half the battle. The biggest risk in trading, the thing that trips up almost everyone, has absolutely nothing to do with the market itself. It's all about what's going on right between your ears. I'm not kidding. You'll hear this from seasoned pros all the time. Something like 80% of your success as an investor has nothing to do with picking the perfect stock or using some fancy order. It's all psychology. It's about winning the inner game. And that brings us to what might be the single most important part of this whole explainer. It's not about being smarter than the market. It's about being smarter than your own worst instincts. Look, our emotions are just terrible investors. Fear makes us hit the panic button and sell everything right when prices are lowest. Greed makes us jump on a bandwagon right at the very top. And things like overconfidence and impatience, they just make us throw our own carefully made plans right out the window for a shot at a quick win that usually doesn't work out. And this is why discipline is everything. It is your number one asset, more than any stock you could ever own. It's what allows you to build a plan, with actual rules for when you buy, when you sell, how much risk you'll take, and then actually have the guts to stick to it, especially when things get crazy. So, with all that said, let's just boil it all down. Let's talk about 3 super simple but incredibly powerful rules. Think of these as the golden rules for anyone starting out. Okay, here we go. Rule number 1, invest early. Time is your best friend, seriously. The more time your money has to grow, the better. Number 2, invest regularly. Don't just do it once, keep adding to it consistently. Even if it's just a little bit, it builds up faster than you'd think. And finally, number 3, invest for the long term. The market's gonna go up and down, that's just what it does. Thinking long term lets you just ride out those bumps. The legendary trader Jesse Livermore said it best. He said, being wrong and not taking the loss, that is what does the damage to the pocketbook and to the soul. And that just nails it, doesn't it? The goal isn't to be right every single time, because you won't be. The real skill is knowing when you're wrong and having the discipline to take a small loss before it turns into a disaster. That's what protects your money and, honestly, your sanity. So maybe the big question isn't just, what should I buy? It's, do I have the right mindset to be a successful investor?